Partnership Sales and Distributions Problem 3. So before watching this video, it's really important to watch Problem 2 on partnership sales and distributions because I go over a broad overview of using what we've talked about in the Partnership Basics video and talk about the distinction in partnership distributions. So here we have a partnership, ABC, equal partnership, and on January 1st, 20x5, A's outside basis is $170, and the partnership's balance sheet is as follows. So we've got all these different assets, we've got $150 of liabilities, and we've got the capital accounts. So specifically, and if you want to stop the video at this point and take note, this problem, problem 3, so on this date, we're going to have 1, 2, 3, 4, 5, 6, 7, 8 different scenarios or situations. So 8 alternative situations. So on this date, A receives the following alternative distributions in complete liquidation of her interest in the partnership. So in problem 2's video, which again I recommend you watch, I make the distinction of when there's a distribution of how there's the first question, if you know there's a distribution, a partnership distribution to a partner, simple versus complex distributions. So complex distributions are when partners receive distributions of property or cash and their interest in hot assets, section 751B, distribution hot assets, is not proportional to what it was before, either because they leave and they don't get their share or if it changes or whatnot. You're going to see in this problem that A's share of hot assets remains the same, and I'll show you how that is. So it's going to be a simple distribution. Okay, so again, simple versus complex. So no complex here. We're doing the basics. We know that it's a simple distribution. Again, I'll show you why in more detail. But differentiating a simple distribution, there's liquidating and non-liquidating. A liquidating distribution means that the partner no longer has any interest. So no interest remaining after the distribution. So no interest remaining after the distribution. And the way you know this is the problem will say that a partner in complete liquidation or no interest afterwards with respect to a distribution. And that's exactly what we have here. It's the key language. So we know that this problem is a liquidating distribution. And again, in problem 2, I talked about how the rules and how they fit together because you're going to see that liquidating and non-liquidating simple distributions have the same general rules, but there's some differences. Now, before we go and look at our fact pattern, and again, I focus and give an overview of the rules that apply to simple distributions, just take note of what A is receiving in these 8 situations. I'm going to talk about them as situation A, situation B, situation C, D, E, F, F1, and F2. Okay? So in situation A is going to receive all of the accounts receivable in land 1, and B, all of the accounts receivable in land 2, and C, 1/2 the inventory in land number 1, and D, 1/3 of both inventory and accounts receivable and land 2, and E, the accounts receivable and 1/2 interest in both land 1 and 2, and F, 1/3 of the inventory and accounts receivable and $120 cash, and then F1 and F2 are going to change the basis of A's partnership interest, A's outside basis in the partnership interest for F1 with respect to F. So it changes it to $100 with the basis for $100 and with the basis for $200. So we're going to see all the different possible alternatives or all the possible rules applying to applying to complete liquidations of simple distributions with respect to A. I said complete liquidation, I meant liquidation of A's interest. Okay, so we're going to see all of those different rules. So keep that in mind. Also, you'll notice in all of these different situations, A through F, you're going to see that A is receiving some share of hot assets. Okay, so the accounts receivable in A, right, and B also accounts receivable. In C, inventory or portion of inventory. In D, 1/3 of inventory and accounts receivable. In E, accounts receivable. F, inventory and accounts receivable. And the reason why is because, again, we're going to see this is going to be a simple distribution because A is making sure to get his or her share of the hot assets, the ordinary income assets going to them in the future, so they're not, leaving without that. So just keep that in mind, okay? So let's go back to our main part. Now, let's talk about the rules that apply to distributions, simple distributions. So with respect to simple distributions, whether it's liquidating or non-liquidating, and again, the way that we break this up, if you have a distribution, a partnership distribution, okay, there's two types. There's simple and there's complex. So complex have complex rules. They're basically disproportionate distributions when a partner is not getting his or her share of the hot assets. We're not going to deal with that issue here. There are special rules, and I do have some discussion of more advanced videos on that topic if you're interested. We're focusing on simple because you're going to see that the partner here, A, is going to get his or her share of hot assets in every case. So simple is broken up between non-liquidating and liquidating. So non-liquidating is also known as current or operating distributions. Those are all synonymous. Liquidating is just called liquidating distributions. And again, liquidating, the key is that there's no interest afterwards of that partner. There's zero interest. It equals zero. Versus non-liquidating, you have an interest. So in problem number two, we saw a non-liquidating distribution. This is problem 3, what we're focusing on. Now in problem 2, I went over the waterfall rules for simple distribution, and we're going to see that there's a table or a chart that we create. So you might remember waterfall rules from other areas of tax. That means that you go down like a waterfall. There's different levels to see how the rules apply, and you always start at the top and you go down, applying what here is going to be the basis. Now if we have a simple distribution, which we do in this case, for simple distributions, partnership, the tax consequences of the partnership, always going to be no gain or loss recognized by the partnership on the distribution. But to the partner, so this chart that in a table we're going to create answers 2 questions. If a partner has gain or loss, okay, and where that's answered, you're going to see here under tier 1, in that situation, you can, and we're going to go through tier 1, 2, and 3. I'm going to explain them. Partner may have capital gain. I'll explain how. Also in tier 3, if it's a liquidating distribution, if it's liquidating, okay, then the partner may have capital loss. But that's the only time you can have gain or loss in those 2 situations. The other idea or other element of the tax consequences this chart and the table goes through, very powerful chart, very powerful table. It addresses the adjusted basis of all property received in the distribution, because you might ask, well, what happens when going forward? The partner takes this property. What if it puts it in service and business or sells it later, right? What's the basis? Well, that's what this chart does. So we go through these rules. We start with tier 1. What we're going to do is, and again, problem 2 is another example of this. We start with the outside adjusted basis of the partner before the distributions. That's our starting point. So we start with the outside adjusted basis of the partnership interest. Then what we do is we go through each tier. Tier 1, we ask, is the partner receiving any cash? If so, well, we know in tax that cash always has a face value basis. We reduce the basis down by the amount of cash. Now, if there's not enough basis, so if the cash amount received is greater than the outside adjusted basis above tier 1, that's when you're going to have, in a simple distribution, capital gain. That's the only time you can have gain in a simple distribution. If the cash amount received in the distribution is greater than the outside adjusted basis. And the reason for that is you can't have negative basis in a partnership interest. Just can't have it. So we create gain to make sure your basis is at 0 going forward. Okay, then what we do is we subtotal the basis and we go on to tier 2. So basis after tier 1, we go to tier 2. Ordinary income assets. We ask, is the partner receiving any ordinary income assets? These are assets that if the partnership was to sell any of its assets would generate ordinary income or loss. And here's the kicker, is that the hot assets for purposes of section 751B might not equal these tier 2 assets. And the main one deals with inventory. Inventory to the partnership is always going to be an ordinary income or ordinary loss asset, but it may not be a 751B hot asset. Why? Because for 751B 751B hot assets, it has to be substantially disproportionate. So keep that in mind. So what we're going to do is we're going to apply a lesser of rule. We're going to do the lesser of the inside basis, and if you saw in problem 2, we do a percentage. We do the same thing here of the amount the partner gets, okay? And the inside basis is what the partnership has, and the partner's outside basis after tier 1. So remember, we subtotal, so you'll see how this works out. Then we subtotal the tier 2, the outside basis after tier 2, and we go tier 3. All property after tier 2 and tier 1 is considered tier 3. So we're talking about capital assets, section 1231 assets. So anything other than cash and ordinary income or ordinary loss assets to the partnership are considered other. Now, if it's non-liquidating, we do the same rule as tier 2, but we're going to see in this problem we don't have a non-liquidating. We saw that in problem 2. So if it's liquidating, then we give the asset whatever the remaining outside basis is. So if we have $1 million after tier 2 left in our outside adjusted basis, and we're getting an asset with a fair market value of, I don't know, $7,500. Well, the rules are, it's a tier 3 asset, let's say, it gets $1 million basis. You give it whatever's left, okay? Now, if it's a liquidating distribution like we're going to have here, and there's no tier 3 assets, so we have tier 1 and tier 2, but no tier 3, then we give the partner a capital loss for the remaining outside basis, and that's how it works. Now, we're going to see all sorts of issues in this problem, so we will get to see all these different things, okay? So that's the general rules. Keep those in mind for this problem, and again, you're going to see that we're going to be doing a liquidating distribution because we saw in our facts that, remember, A is liquidating in all situations. All right, so now that we have that, we can go right to our fact pattern, okay? And what you have here in front of you, down the bottom, you've got this table or chart. And this is what it should look like at the beginning, okay? If you're doing liquidating or non-liquidating simple distributions, it looks like this. Now we've got, again, 8 different situations, right? Situation A, B, C, D, E, F, F1, and F2. But on the left here, you want these rows. You start with your outside basis row, then you go tier 1 cash, okay? The amount of cash. Then after that, we do a subtotal, so you'll see the lines for subtotals. Now, if the subtotal is negative, we do have to give that partner, which here, remember, all these are addressing A, right? Partner A, who we're going to assume is an individual in all of these, just different situations. If it's negative subtotal, we give it gain. We then go to the next one, a subtotal as well, and then we ask, are there any tier 2 assets? Now, in this fact pattern, looking at our list of assets, we've got cash, right? Cash is obviously tier 1. We're asking in the hands of the partnership. Accounts receivable to the partnership is always a tier 2. Inventory, always tier 2. Again, remember, 751B, you need substantially disproportionate, substantially appreciated inventory. But for this one, tier 2, it's any inventory. Land 1 and Land 2, we're going to assume that Land 1 and Land 2 are either going to be a 1231 asset or a capital asset because we're not told that, the partnership's a dealer in land. So we're going to say both of these are 3. The stock is also 3, right? Stock non-marketable is 3, and those are our assets, okay? So we got tier 2 assets, which could be the accounts receivable inventory, and then tier 3 could be anything else, the Land 1, Land 2, or the stock. Now what we're going to do is we're going to put A's outside basis. We're told A's outside basis, which is 170. We're going to put that at the starting point for A situations A, B, C, D, E, and F. I'm not going to do it for F1 and F2 because in F1 and F2, we're specifically told what if A's outside basis was 100 in F1 and 200 in F2, so it changed that. That was the key thing. So I'll put a little star on that one because the basis changed if you want to know where that came from. Again, that was in the facts. And I'll go back to the facts just to remind us right before we go into this. So if you want to stop and take note of the elements, because I know it might be a little bit hard to read, but we'll go back and I'll show you. But that's going to be our starting basis. Now, notice I tell you in the problem that A's outside basis is 170. Again, I tell you 100 and 200 in F1 and F2. But you could also figure that out in this problem. How? Because we're told that A's tax book, which is the adjusted basis of the capital account, is 120. And then we're also told that there's liabilities of the partnership, right? And we don't know what kind of liability this is, but we're just told it's an equal partnership. So profits, losses, there's 3 partners, right? A, B, and C. So we have a 1/3 interest in both. So whether it's recourse or non-recourse, A's share is going to be 150 times 1/3, which is $50. So if you take 120 plus 50, you get $170. So that's where the 170 comes from if you were wondering. Okay, so that's the 170. Okay, so then what we're going to do is we're going to ask, okay, do we have any cash, tier 1? If we do, we put it there, and then we subtotal, we subtract away. Of course, the cash is the amount of the face value is the basis. If it's negative, we give it gain, we go down, subtotal that, then we go tier 2. Whatever basis we have left, we're going to allocate to tier 2. We ask in that specific situation, does A get any tier 2 assets, which again here are the accounts receivable and inventory. So we need to look at that in the alternative situations. And then tier 3, are we getting any land 1, land 2, or stock, and we go through. And again, 2 things in mind. We're looking for any gains, so we can have gain here. And then it's possible also in a liquidating distribution, which again, remember, all these are liquidating, you can also have a loss. You might have a loss. So we need to keep that in mind. That's also part of it. And the other element is the basis of everything received is determined in this table as well. Okay, before we go through the mechanics and follow our rules, I just want to zoom in one last time. Remember, again, it's a complete liquidation. So it's a liquidating interest of A's interest, and this is what A's getting in the different situations. So if you want to stop and write this down, in situation A gets accounts receivable in land 1. B, accounts receivable in land 2. C, 1/2 inventory in land 1. D, 1/3 of inventory, 1/3 of accounts receivable in land 2. E, accounts receivable in 1/2 of land 1, 1/2 of land 2. F, 1/3 of the inventory, 1/3 of accounts receivable, and $120 cash. And then F1 and F2 changes up the basis at the top in the same application of F. All right. So now let's go ahead and we are going to start the fun. We're going to go I think it's fun. And once you do this table enough, you get the hang of things. All you can really have, on whether you're taking an exam, you're taking the CPA exam, in practice, if it's a simple distribution, just a change in numbers. That's all you can have, okay? So in situation A, we're told that partner A gets accounts receivable in land 1. So the first question is, do we have any cash in this situation? And at first you say, okay, well, we're not told we have cash. However, and this is where you got to pay close attention, liabilities. So in problem 2, I noted that there was no liabilities because liabilities affect things liabilities, anytime you have liabilities in tax and property transactions, always, always, always take note of the liabilities. So if A is leaving the partnership and A is responsible for $50 of liabilities, the tax law in section 752 under the regs treats this as a constructive distribution of cash. So what I'm saying is that A is receiving $50 of cash in A, B, C, D, and E. Now F1 and F2, A actually gets cash, so we'll keep those for later. Okay? So in situations A, B, C, D, and E, again, looking at the facts, look, you see in A through E, there's nothing there about receiving cash. But the relief of liabilities, guess what? That's treated as constructive cash. So we do have to consider that as tier 1 cash. We do have to consider that. Very important to do. Okay, very, very important. If you miss that, you will get this, this will be wrong, okay? You will get stuff wrong. So that is very important. So if you see liabilities, red flag, note it, make sure that you highlight that. Okay, so what you're going to see, I'm going to go ahead and do A, B, C, D, and E right now, all the way through this, because again, there's no cash received in A, actual cash received is only constructive. So if you subtotal, right, because this is all subtraction, right, the basis, of course, in the cash is 50, we're going to get 120 as a subtotal in all 5 situations, A through E. And we'll go through each situation independently in a moment, but just bear with me. So again, you can only have gain if at this point, if this subtotal is negative, but we don't have negative. So no gain in A, B, C, D, or E. And we bring down that 120. We bring down that 120, and we move on to the next tier. Okay, so again, I'm going to go ahead and read this. I know, and if you need to go back and look at, pause the video to look at what A receives in the different independent situations, please do that. You can come back forward to this part. But in A, it says that A receives the accounts receivable and land 1. So using our waterfall rules, and if you want to go back and look at that, you can too, and take notes on that. I have that in the basic discussion partnership video. If A is receiving accounts receivable and land 1, we ask, does A receive any tier 2 assets? And we look at our list. Accounts receivable, that's what A is receiving here, is a tier 2 asset. So we're going to put that down. We're going to put down accounts receivable. Now, A is receiving all of the accounts receivable. The rule under our waterfall rules, when we get to tier 2, we carry out the inside basis limited to the outside basis. So the inside basis, that's what this is, right? That's the partnership basis in the assets. Accounts receivable is 0. The partnership has a basis in accounts receivable of 0. So it's the lesser of 0, right, the inside basis, or the outside basis after tier 1's all done, which is 120. So that's going to be, and we're doing situation A now. I know earlier we were doing A through E because that was all. It's all going to be the same to save us time. So accounts receivable, the lesser of 0 or 120, right? 0 inside basis is 0. So now we receive one other thing, land number 1. So that's a tier 3 asset. So we bring this down, right? So the accounts receivable is a basis of 0. That's what we're doing. We're determining if there's any gain, and we're determining the basis of property. And also if there's a loss at the end, and you'll see how that works out later on. Okay, do we have any tier 3 assets here? Yes. We have land number 1. So our rules say if liquidating, the distributed assets in tier 3 take the remaining basis. And that's because we don't have there's no partnership basis. If you put outside basis here, right, like I did in problem 2 where it's a non-liquidating, that's wrong. That's very wrong. And the reason why is because this is a liquidating distribution. This partner A no longer has an interest in the partnership, and we don't care about, what basis do you have in your partnership? There is none. There is no partnership basis. There is no outside basis. It's gone. It's wiped away. So everything, the subtotal here is 120. Everything goes to land number 1. Now notice land number 1's fair market value is 120, and 120 goes, so that kind of equals out. But we don't care what the fair market value is. Notice for tier 3, we didn't even look at the numbers. And you'll see that's even more the case as we go. So let's go to situation B. So situation B, very similar to A, except instead of receiving land 1, partner A receives land 2. So in B, situation B, partner A gets all of accounts receivable, which again is the lesser of 0 inside basis or 120, so that's going to be 0. Okay, so we bring down 120, and land number 2. So the rule is it's going to be not lesser. See, got to catch yourself. If this was a non-liquidating, it'd be lesser. Right? Woo, caught myself. No, if it's liquidating and you have a tier 3 asset, the tier 3 asset takes the remaining. So we just give all 120. Notice in land 1, land 2 for the partnership, very big differences in the inside basis and the fair market values. But we don't care. We give whatever's left to the partner. That's how it works. Okay? That's how it works. Now, if you're looking at tax planning and tax elements, which basis would the respective, which basis would the partner rather have, or which one, land 1 or land 2, would they rather have, just from a tax standpoint, right? It makes no difference because the partner is going to take a 120 basis in land 1, land 2, because that's how the rules work out. But what about the partners remaining, right? Partners B and C. Well, notice in land 1, the basis is 180, and if that's given up, guess what happens? That it has a basis of 180, a 120 fair market value, a loss, and then the partner takes that 120. That $60 of loss that's built in here, see that $60? 180 to 120. So if the partnership were to sell it, right? Assume the partnership sold this land 1, consider a different alternative, right? Partnership sells the land. If the partnership was to sell the land for $120, land number 1, it would recognize a $60 loss. And it'd be allocated out. And losses, as we know in tax, are good because they lower taxes, right? If you can take them, right? Subject to all the limitations. So it's actually partner A is indifferent between receiving land 1 and land 2, but partners B and C, right? The partnership, they are not indifferent. They want to give up land 2 and keep land 1 because they want to keep that lost property, so the partnership later sells, they can take the loss. Versus if they sell land 2, because they're both worth $120, there's a $30 gain they're going to have to take. So see how that works out? So there actually can be some negotiation potential here, right? Where in situation A versus B, right? If partners, if A was like, well, I rather have, or I don't really care, but B and C want to keep land 1 and give up land 2, then A's like, if you really want that, you got to give me like a few extra dollars on the side or something. That can happen. That type of stuff happens all the time in tax, in real practice. Okay, but that's the tax consequences with respect to partner A. There's no consequences to the partnership, right? Because again, it's simple distribution, no gain or loss, and that's the consequences to A. There's no gain. We saw that. There's no loss. And by the way, remember, the only time that partner A can have a loss is if there's no tier 3 assets. If there's no tier 3 and there's remaining basis, we're going to have a capital loss. But we have yet to see that because we have land 1 and land 2 so far. Let's go to situation C. So in situation C, now we change it up a little bit. Now A is receiving, so partner A is receiving 1/2 of inventory and land 1. So again, the rule is in tier 2 assets, we carry out the inside basis, right? The inside basis is 30, right? I just circled that. I'm going to put a little C next to this. So C's calculation is going to be the 30 inside basis of the partnership, but remember, A is only receiving 1/2, so that's actually 15. So it's going to be the lesser of, and there's no accounts receivable received here, but there is inventory. Okay? It's going to be the lesser of the 15 we just calculated because A is receiving 1/2, or 120. And of course, it's going to be 15. So we subtract that away. 120 minus 15 is 105. And then A also receives land number 1, and then again the rule is if it's a liquidating distribution, which it is, and you've got a tier 3 asset, all 105 goes to that tier 3 asset. So in situation C, guess what? Partner A gets land number 1, and land number 1 takes on 105 basis. Okay, so I think you're getting the hang of this. You just apply the rules and you use this chart. Works out pretty well, right? And we saved a lot of time by going through the first part of A, B, C, D, and E with the cash, right? And getting that taken care of. Okay, in D, 1/3 of inventory and accounts receivable, so 1/3 of each of those, and land 2. Okay, so now we have accounts receivable and inventory. So I'm going to put a D next to accounts receivable, also next to inventory. We're going to calculate those amounts. So of course for accounts receivable, put A/R. That's 0 times 1/3 because A is receiving a 1/3 interest. And then for inventory, that's 30 times 1/3, which is 10. So that's what we're limited to with our inside basis. So we have 120, so that's a lot. So for accounts receivable, the lesser of 0 and 120 is of course 0. And for inventory, the lesser of 10 and 120 is 10. So we bring down, that's going to be a 110 left over. And partner A is getting land number 2. So we give land number 2 110 basis. So it's just whatever is left. Notice how that carries out. Just goes to that specific asset. Now, again, I want to remind you, this chart, which is this table, very helpful, does 2 things. Again, we have no gain in A through E because, again, we went through that and there was no negative subtotal after the cash. And we don't have any loss yet because we still have tier 3 assets. But it also determines the basis, right? This is the basis of the cash, which is always face value. Just want to remind you. This is the basis of the accounts receivable and inventory, this line. So in situation C, for example, right? Remember, A received 1/2 of the inventory, so A takes a basis in the inventory equal to 15. In D, A received 1/3 of accounts receivable, A takes a basis of 0, and 1/3 of the inventory, A takes a basis of 10, and then receives the land, right? And this is the basis of the land received. So that's what we're doing. We're determining the basis of the property. So that way going forward, A knows what basis, if A is selling it in the future or using it, in business or whatever it is. So let's go to situation E. So situation E actually is a special rule that we're going to learn about. I'm going to teach you that rule, show you how that works. So in E, we've got the accounts receivable and 1/2 of land 1 and 2. Okay, so there's no inventory in this one. All right, so all the accounts receivable. So all the accounts receivable inside basis is 0. So the lesser of 0 and 120, of course, is 0. There's no inventory. So we bring down 120. Okay, so now we're getting 1/2 of land 1 and 1/2 of land 2. So this one is a little unique. If you have multiple assets, what you're going to do, and there's a few rules that we use, but I want to show you at least one rule because, again, I know this is supposed to be a basic discussion, which it is, but I want to show you one little interesting quirk. We've got 120 left to allocate between two assets. When you've got one asset, it's easy, right? In situation A, B, C, and D, we had one asset. Boom, we give all of it left, right? 120 to land 1, 120 to land 2, 105 to land 1, 110 to land 2, respectively. But when you've got 1/2 of land 1 and 1/2 of land 2, which are two separate assets, and you have 120, the question is, how do we allocate that? Do we use relative fair market value? What do? Do we use relative basis? So here's what we do. The first rule, and you're going to see it's the only rule we're going to apply here, is we look at if there's any property that has declined in value. And look at this. Land number 1 has. Land number 1 has, well, I shouldn't say decline in value. I mean, well, it is. It was purchased at 180, right? That was the basis, right? Land, and the value has gone down, so it has declined, right? So we call it substantially depreciated in value, okay? So we've got E and E, right? We've got 180 basis of land 1 and 90 basis of land 2. So we have a calculation here. I'm going to calculate that, right? For land 1, it's 180. That's the inside basis to the partnership, times 1/2, because that's what A is receiving, is 90. And then for 2, we've got 90 is the inside basis, times 1/2 is 45. Now guess what? If we add those together, we get 135. Notice we only have 120 to allocate. If we had enough to allocate, we'd allocate it, but we don't. So when we have any property that's gone down in value, right, which property land number 1 has, right, this is 180, so 180 to 120, it's gone down. What we do is we allocate the difference, right? So we have 120 here. So 120, sorry, let me rewrite that. It should be 135. The 135 basis that we calculated minus the 120 that we have to allocate, the outside basis. That's a $15 difference, okay? So we're going to allocate that $15. We're going to subtract it away from this 90 to the extent of the decline in value, which there's $60 of decline in value, right? 180 to 120. Or if you took half of those, right, a 30, right? 90 and 60 if you took half. So that's all I just want to show you. It's a special rule. If you're just doing a basic overview of partnership, you probably don't have to worry about that. But that's how this actually works out. So 90 minus 15 is 75. And then, of course, land 2 gets 45. So we give 75 to land 1 and 45 to land 2 because, again, special rule is we allocate the depreciated, the assets depreciated gets allocated the difference. Okay? And notice 75 plus 45 is 120. All right, so that was a special rule. Just wanted to throw in one special rule. So now we're going to F1 and F2. So these change up a bit. So in F, we're told that partner A is going to receive 1/3 of inventory, 1/3 of accounts receivable, and $120 of cash. So $120 of actual cash. Let's just put a little arrow up here. Actual cash received in F is 120. But then remember, we've also got this liability relief, also known as constructive cash, of 50, and that equals 170. So there's actually actual and constructive cash together, 170 cash. So that brings our basis to 0. Hey, it's not negative, it's 0, so no gain. And we have a subtotal of 0. Now, A is also receiving 1/3 of inventory and 1/3 of accounts receivable, but the rule is you go to tier 2 and you carry out the lesser of the inside basis or outside basis. And if you have 0, guess what? Both of them get 0 basis because you don't have anything to allocate. And then it also says if you get to tier 3 and it's a liquidating and there's no tier 3 assets, which there's none, then you take a capital loss. But we don't have any basis left over, so we don't have to worry about it. So there's no capital loss in F1. So what if we have the same situation? Okay, same exact situation as F, but in F1, we just change our basis from 170 to 100. Okay, well, we've got 170 here. Now we have a negative 70. Negative, right? Negative subtotal. If it's negative, right, remember this rule, if it's negative, we have gain equal to the same amount to make it a 0 basis. So that means that in F1, partner A is going to have a $70 capital gain. Put a little star there. It's a capital gain of $70. That's going to be an increase. We add. That's the only time we add in this these columns. That brings our basis to 0. And again, partner A is getting 1/3 of accounts receivable, 1/3 of inventory, but there's nothing to allocate. So 0, 0. And then again, there's no tier 3 assets, but it's 0, so there's no capital loss. So finally, in F2, what if our basis? Same as F, but it's 200. So we take minus 170. That gives us 30. 30 as our subtotal. That's obviously positive, so there's no capital gain. We bring down 30. Okay, now we're getting 1/3 of accounts receivable, 1/3 of inventory. So that's the same calculation that we did in D, right? That's 0. We're limited to 0 inside basis of accounts receivable and 30. So, of course, accounts receivable is going to 0. And then for inventory, we're limited to 10 and 30, which is 10. And then we have a $20 basis left. But look at this. We have no tier 3 assets. When we have a positive number here and no tier 3 assets remaining, okay? So if we have a number here and we have no tier 3 assets remaining, this is the only time in a simple distribution where we can have a capital loss or a loss, any loss. So we're going to have a $20, I'll put in negative so it's a loss, a capital loss, which will be long-term capital loss if held for more than a year, right? The partnership interest held for more than a year, short-term capital loss if a year or less. Just like in F1 with a $70 capital gain, right here, if the partnership interest was held for more than a year, it'd be long-term capital gain, a year or less, short-term capital gain. Okay, same with the capital loss, the same rule. So those are the only times we can have capital gain, capital loss, those situations. And then we've gone through all the situations, right? Situation A, B, C, D, E, F, F1, F2. We've looked at capital gain, capital loss. The only time we had capital gain, capital loss to partner A was here, capital gain, here, capital loss. And the other thing that this table helped us with was determine the basis of the cash received, accounts receivable, inventory, land number 1 and land number 2 in each situation, the amounts. And that's what this table does. So go back over this, go through all the elements, watch problem 2, watch the basic partnership video which walks you through the steps of the waterfall in more detail, but this really shows you. Go through this, get to the point where you can do both problem 2, problem 3, and you can do them without watching the video and do them without looking at the waterfall rules. Set up your table, go through it, because all you can have on an exam or change up on a simple distribution, even in practice, is just different numbers. All right, so I hope you've enjoyed this video. Again, I really like using this table. It really helps out a lot.